Hello and welcome to this joint webinar between the Australia-Indonesia Centre and the Cross-Sector Development Partnerships Initiative, or XSPI. I'm Helen Brown. I acknowledge the traditional owners, the Kulin Nations, of the land on which the Centre's office is located and the City of Melbourne, from where I am hosting today's webinar. We pay our respects to Elders, past and present. The Centre's mission is to build on and strengthen people-to-people links between the two countries, Indonesia and Australia. XSPI believes that increased collaboration between the private and public sectors is critical to achieving sustainable development goals. So you've joined an appropriate and timely discussion about one of the big issues of our times. Before we go into those issues, we're going to hear firstly from a leader in the field whose job it is to help steer Indonesia towards its greener future. Many of you will know Dr. Mari Elka Pangestu. She was appointed recently as the Presidential Envoy overseeing the Global Blended Finance Alliance. Now, this is designed to accelerate investment in climate action and sustainable development goals. Dr. Pangestu was appointed by former President Joko Widodo, or Jokowi. The new Prabowo presidency has just committed to the bold plan to phase out coal by 2040, announced at this year's COP29 talks. It's estimated this will cost around $1.2 trillion if it means the country is able to fully transition to the renewable energy it requires. So bold plans and ambitions, and a financial facility that the country is keen to use. That's the blended finance through that alliance. Dr. Mari Elka Pangestu is, of course, also an Indonesian economist with more than 30 years in academia, second-track processes, international organisations and government, working in areas related to international trade, investment and development in multilateral, regional and national settings. She has served as a World Bank Managing Director, Indonesia's Minister of Trade and also the Minister of Tourism and Creative Economy. She is a current member of the Australia-Indonesia Advisory Board. She is a very busy woman and we greatly appreciate her time with us today. I'm very pleased to say as well that she's able to take a few questions after her keynote presentation. Dr. Pangestu, thank you for your time and please go ahead.
Thank you, Helen. Can you all, I suppose you can all see me and the presentation on the screen. Let me just spend about 10 minutes giving you a broad overview of blended finance and the G20 Global Blended Finance Alliance, which I have been working on for the last year. So if you can go to the next slide, please. Really, the Global Blended Finance Alliance is about addressing the financing gap for climate finance that we see in the world today. I mean, as we all know, the gap is huge. It's like anything from 1 to 3 trillion just for climate finance. And then if you add sustainable development goals, it comes up to 6 trillion. In 2015, when we had the Paris UNFCCC, developed countries agreed to raise 100 billion to support developing countries in their climate gap. But as you know, it took them 7 years. It was only achieved in 2022. And recently at the COP29, the new 100 billion, as they call it, is now, there's a commitment now for 200 billion. It's a doubling. But I think the gap, as we all know, is still very large. And if you look at the, the issue is basically the 100 billion or now the 200 billion is developed countries funding, as well as coming, there will also be some coming through the multilateral development banks. These are what we call catalytic development funds, which is supposed to crowd in private sector. And if you look at the bar on chart on 2022, it says here that the crowding in of public funds or catalytic funds is still very low or very slow to be able to crowd in private investment. In 2022, the number here is that for every $1 of public funds, you're only being able to crowd in about 30 cents from private investment. Next slide. Next slide. And on top of that, the amount that is being crowded in is very small from private sector. And most of that is going to developed countries. Developing countries face systemic barriers in being able to crowd in climate finance, starting obviously from the risk that they are perceived to have. Emerging developing countries have, a lot of them have credit ratings below investment grade, and therefore high capital costs, high risk. And the lack of climate finance data and standards, as well as the absence of critical policy and regulatory frameworks. And in the case of wanting to have public funds that will include budgetary funds from the government to be able to crowd in private funding, there is also limited fiscal space when you talk about developing countries. And then finally, there's the human capital and knowledge gap, the capacity to be able to structure these blended finance structures and prepare the projects is really not in a good place for developing countries. So you basically have the private sector saying, okay, we have the money. GFAN says they have 130 trillion in financial assets that and financial funding they can deploy, but then they ask, where's the projects? And developing countries are saying, well, we need the money. We are trying to come up with our plans. Where's the money? So the two don't meet. It's a bit, this is the crux of the problem if you try to summarize it in a nutshell. Next slide. So why does sustainable finance matter? We all know that it's benefiting for investors because it really can support access to new geographies and asset classes. And it can also be the fact that sustainable finance can be de-risked investment opportunities. And this is where blended finance comes in and can offer reputational benefits. Most institutional investors and all kinds of investors like banks, they all have to say that they are funding green projects or sustainable projects. Of course, it should benefit the companies as well to be able to finance their transition. And also the fact that a lot have to transition away from black or brown sectors to green sectors. And over time, if you can actually prove that you are doing sustainable business, it should be able to give you cheaper capital over time. And finally, we know that this is very difficult to realize these benefits because of the fact that it's really there has been some successes in blended finance or transition finance, but being able to replicate and scaling it up has been really quite a challenge. So it won't work for every business because it requires green projects that have very solid transition strategy and cannot promise a cheaper financing at this moment of time. So how do we address this? Next slide. Here are some case studies that we can share with you. This is how we think to typically see what blended finance is, that you have catalytic capital. The providers can be governments, MDBs, development finance institutions, or philanthropies. And the forms can be first equity loss, political risk insurance, credit guarantee, or junior debt and equity. And the recipients can be emerging market institutions, innovative impact-oriented enterprises, experts on project implementation, and obviously project collaborators. The opportunities are how to integrate everything to come to one platform, whether it's the technical assistance, the financial support, or the data. And I think the big challenge we keep on hearing is, where are the projects? Where's the pipeline of projects? So how do we develop the pipeline of projects? And how do we mobilize private finance at scale to be able to finance these large projects or portfolio of projects? And there needs to be transparency as well as the measurement of the impacts and outcomes. The challenges are that they're very complex, and there is limited pipeline at the moment of proven bankable investments. And you do require large-scale institutional push and sponsorship to draw investor demand, whether it's governments or whether it's the large multilateral development banks, or a combination thereof, including investors. Next slide. This is an example of a blended finance structure that is trying to happen for the Just Energy Transition platform of Indonesia. As some of you who are working in this space will know, Indonesia launched a Just Energy Transition platform, one which is more government-led and the other which is kind of G7-led. And the idea is, how do you fund coal phase down and then have the just energy transition component work, including the cleanup costs and the funding the risks, funding the costs to the coal producing region. And then where it would be commercial would be in the investments of the renewable energy. This is where we have the example where ADB came in with the World Bank and Climate Investment Fund, as well as a number of other authorities to come up with the finance. ADB came in with a $500 million loan to crowd in other sectors, other financiers. And the idea is to shut down one of the coal-fired power plants earlier than before, but then came some of the complications in terms of what does it take to have the renewable energy component work. You needed to have the feed-in tariffs of PLN to be competitive. You needed the local content requirements to be addressed. And up to today, I think we're still working on the coal phase out of this one particular coal plant. And this happens to be a private sector one. The moment you get into the PLN power plants, then it becomes more tricky. So at least this is what it should look like. But it does, you do need to have the clear guidance and strategic direction of the government in terms of the policy frameworks and so on. And then you need to have all the partners come together to be able to blend grant, equity, concessional loan, and commercial loan and guarantees together to be able to finance what wouldn't be financed otherwise, such as the coal phase down or coal phase out, the cleanup costs, the cost to the social economic costs, and then the rest could be commercial, such as the renewable energy deployment. But on grids and transmission, that's still not clear whether that should be partly concessional or can it also be commercial, depending on how you structure the regulations around that. And the fact that PLN is still a state-owned monopoly that is the monopoly for distribution and transmission is part of the complexity. So that's on Indonesia and trying to make blended finance work. Next. Okay, finally, let me just briefly tell you what is the Global Blended Finance Alliance and what is it trying to do. Next. This was a G20 initiative that started in 2022, but before that, there had been a lot of discussions around how to have, how blended finance can be part of the answer to the climate financing gap, as well as the sustainability development financing gap. And under President Joko Widodo, this was G20 2022. And then in the next 2 years, we had worked hard to make this happen as an international organization. And it has received the support of the current president. Next. Next. What is it trying to do? Can you go back, please? Basically, it's about South-South cooperation and having a global alliance to bridge the SDG and climate finance gap and mobilize blended finance at scale. And the three pillars that we think are important is to, first of all, you need country-led platforms. How do you facilitate countries to design the right kind of country-led platform for their climate action? It can be energy transition, it can be nature-based solutions, it can be adaptation or a combination thereof, but there needs to be a country platform that is well designed, including the regulations and reforms and the direction of travel in terms of the policies and the targets. And then you need institutional capacity building, which is about partly the government institutions, but also, what are the infrastructures that you need? Say you do end up having a carbon market, you will need the services that go with carbon market, such as verification and so on. And you need the project developers, you need the financial sector to also be able to subscribe to a sustainable finance architecture and so on. And then the final component is the convening and partnership. How do you bring all these different parties together, which is really those who have the funding but have different risk appetite and objectives, together with the projects and things, the investment needs and projects, which is also a combination of needs and projects which have zero return all the way to commercial return. How do you bring all that together? Next slide. So this is what we're going to be doing. We're going to try to do research as well as, first of all, on the country-led platforms. We think two areas. One is the energy transition, looking at Indonesia, India, South Africa, and then for the nature-based solutions on the forestry side, probably looking at Brazil, Congo, and Indonesia. And then on institutional capacity building, providing the training, the facilitating of knowledge sharing platforms, and professional development. And then finally, on the strengthening of the partnerships, how do we bring all these different parties together to start working around a portfolio of projects? Next. I think that's it. Thank you. That was just a very brief introduction on global blended finance and alliance, as well as the importance of blended finance as the answer to addressing the climate and sustainable financing gap.
Thank you very much, Dr. Pangestu. That's great to have that explained and that structure. And you've really given us an idea of some of the complexity of the issue now, which we always knew was complex, but those charts really map it out. Would we be able to have access to those afterwards, Ibu? So if anyone would like to, great. Thank you very much. I know that we have a lot of people attending who are strongly interested in this subject. Ibu Mari Pangestu has kindly offered to answer any questions that you have. She's only with us for a short time. So if you have a question, could you put it in the chat, please? You can also see on screen now our fabulous panellists, and I will introduce them to you shortly. They may even have a question themselves. They all work in this area to some degree. But Ibu Mari, if I could ask the first question, how confident are you that the challenges that you've talked about can be worked through to get to the point where you do have a mix of finance that comes together to create something that's truly transformative? Oh, you may have to unmute.
There are many challenges, but I think for me, it always starts at the national level. I think investors clearly want to see commitment, long-term commitment from the government. And it's one thing to announce your NDCs and your target for net zero by 2060 or by 2070 or 2050. But I think investors would really like to see the how-to. How does the government plan to do this? And so you need to translate these plans into investment needs. What will it take for us to do energy transition? What's the cost? What are the types of investments needed? Whether it's the less commercial ones, like phase down or phase out of coal-fired power plants, all the way to the potentially commercially viable renewable energy. And then you have the grid and the transmission, and then you have all the other things that need to come together if you're going to have a successful energy transition. So you do need countries to be able to design such plans clearly, and what they intend to do in terms of how much government budget is available to finance some parts of that. What are the institutional changes that are needed, including in the case of electricity? Obviously, many countries have this problem of a state-owned institution that is running the implementation of electricity deliverable. And then you have nature-based solution. That's yet another series of policies. Then so you need to be able to translate from government targets to comprehensive whole of economy, whole of government, whole of society approach to what needs to be done. And then what does that mean? How do you translate that into investment needs? And what part of the investments will be government funded, and what will be needed in terms of blended finance and crowding in the private capital?
Thank you. I see we have a hand raised. Perhaps if you could type your question in the chat. I have another question here, which I will get to in a minute, but I just wanted to ask Ibu Mari, how long are we talking about then? You've just outlined the complexity. A lot of it needs to be government driven. What sort of timelines are we realistically looking at for this to be successful?
I think to get the first part done shouldn't take too long, but to actually get it translated into investment and projects, of course, will take time. Brazil actually has provided a good example. Brazil announced, they call it the ecological country strategy. They announced that last year at the World Bank annual meetings. Or was it last year at the COP, or was it earlier this year at the spring meetings? But they announced it, and they are now, it's being led by their Ministry of Finance, as well as the Regional Development Bank of Brazil. Then they translate that into investment needs, and then they go out and try to structure the portfolio of projects. So, of course, that part will take time, but I think having the clear direction at least gives you a good base and a good moment to start. And we think this is the way countries should go.
A question from Judy Anderson. How are these projects engaging with communities on the transition from coal to renewables and the employment shift, which she notes is a challenge in Australia, and we even have an authority to assist on that? Is that something that you have knowledge of?
Yes, because from the beginning, developing countries as well as Indonesia included, we insisted on having the word just in there. It's not just energy transition per se, but it has to be just. Just meaning that it must take into account the communities that are affected. In some cases, it can be indigenous communities as well. So the social cost as well as the economic costs need to be really incorporated into the analysis of the energy transition. And in the case of Indonesia, the Just Energy Transition platform, which has a secretariat, actually has one component of it looking at the just energy transition. But of course, it needs time, and it needs a lot of stakeholder discussion for countries and communities to get it right. And government, local and national governments need to be on top of that, as well as communities that are around there.
Thank you. We have a question from Richard Matthews, and yes, the chat function is off. Sorry, I meant the Q&A, so my apologies. What are the main disincentives to increased private investment in renewable energy in Indonesia, You mentioned PLN's monopoly. Is that really a hindrance? Could it be turned around to an advantage with sufficient political will?
Obviously, I mean, there's no way we can accelerate renewable energy production and investment without the private sector. So we need to understand what are some of the impediments. The impediments have been around the certainty about, the renewable energy mix and the policies around that, including the feed-in tariffs, which are still considered to be not very competitive at the moment. And the fact that, you can't, the investment in the renewable energy needs to happen in parallel with investments to modernize your grid and the transmission. And should PLN be just focusing on the grid and transmission, and then let the private sector do the production and then charge the fees, earn their income from charging the fees from and ensuring that you have efficient and modern grids. So this is some of the discussions, the ongoing discussions that are happening right now, and whether or not we have local content requirements. How much should we have that? Some have identified that as a constraint. I think we need to do a good analysis to understand better. Is it better just for us to import from the lowest cost technologies, which happens to be China? Should we do our own production, or both, right? At some point, if you have enough scale domestically, it does make sense to produce domestically. But how should you design that increasing domestic value added strategy is going to be key also.
Following on from that, we do have a question around if Indonesia does create new products, is the IP system in place to ensure that they are properly patented and protected, but it doesn't take too long? I don't know how much you know about that, but that is a question in the room. It's around innovation.
I think if it's standard technology like solar panel, that's probably not an issue today. But if you talk about the more innovative innovations, of course, countries that have the technology or companies that have that technology would want it to be protected and not copied. I think we have a relatively robust IP regulations. Now it's more a question of enforcement. And making sure that you find the right partners or the right deployment of these technologies to ensure that they are being used in the way that they should be used. So I think it's a good point. If we really want innovation to happen here, we really need to make sure that we can protect the IP.
Thank you. I'm going to start bringing in some of the other panelists because I think what you're saying, they can also talk to as well. And I know we only have you for a short time, Ibu Mari, so please just let me know when you need to leave. But you talked about the huge amounts of private capital that is actually available, but is trying to find projects. We've got a couple of panelists who are actually working on that, and Francois de Maricourt is from HSBC. He's on our panel today and is working as part of his role in this global bank on this particular problem. Francois, thank you so much for joining us today. Can you just talk through what Ibu Mari has mentioned around the amount of capital that is actually available but just doesn't have anywhere to go at the moment?
Yeah, I think that this was really a good point that was made by Ibu Mari, because if you look at the banks have actually set aside a call of capital and call of financing for blended finance and supporting the transition to net zero. In the case of HSBC, we have committed $1,000 billion for green projects. So the money is there, absolutely. The question is, how bankable are the projects and what can we do to de-risk them? Because, of course, the vast majority of these projects are in developing markets, but at times, the risk level is too high for private finance to finance them. And this is where blended finance could be a very powerful tool in order to de-risk certain projects. However, what we have seen is that actually blended finance is not a new concept. It has been around for quite some time. And still, there is a very small amount of financing that is done using blended finance. For a couple of years, it was around 9 billion. Last year, there was an increase to 16 billion. But compared to the needs, this is completely insufficient. And we need to have much more blended finance to come. And we need to have the private sector to be able to be crowded in, which is a plan. But having said that, this is not really happening. And at time, actually, the private sector is crowded out by the MDBs who tend to finance perhaps some of the easiest projects that could be financed by commercial banks. So that's really one of the risks, because the KPI are not always based on blended finance, much more on how much funds they can use in order to finance the transition to net zero. Having said that, there are some good examples. And as Mari mentioned, in Indonesia, part of a JETP, there is one specific project to early retire a coal-fired power plant, CFPP, which is called Cirebon Satu. And under this project, the idea is that the de-risking will be done by ADB, and the private bank will provide the rest of the financing. It's a very complex project. It was due to be closed already in early 24, and there was an MOU that was signed already actually at the G20 meeting 2 years ago, and still is still not closed because it's very complex, and the fact that PLN has a monopoly of electricity does not help really. So I think that there are quite a lot of projects that are being looked at in terms of blended finance, and in Indonesia, the JETP should help it, but this is quite slow to happen, much slower than what was expected. But I'm quite optimistic that in the years to come, we'll see an increase, because if you just see the numbers, just to meet its NDC, Indonesia will need to have something like $300 billion of investments. And clearly it cannot be public money alone.
Yeah. So thank you, Francois. So you're talking about how private finance is trying to find a way in at the moment, but it's got to go through many options to try and find that suitable pathway for a number of reasons. I just want to check if Mari is still with us or not, because I don't want to chew up all her time, but it's also good to have her.
I need to go, but thank you, Francois. We've been on many panels together. Totally agree with you. So I think the challenge is really, how do we break down some of these. Some of them are regulatory barriers, some of them are institutional barriers, some of them are just how complex it is to structure these things. One thing, Indonesia hasn't got everything right yet, but I think the whole Just Energy Transition platform partnership process has actually at least brought all the different government agencies together. And let's hope that the new government, which has made, I think people are sort of looking at the statements being made recently about the commitment to do coal phase out or coal phase down. So let's hope that we can continue to work to get all the parts come together in the right way. So apologies, I have to leave, but thank you for the invitation, and looking forward to the results of your discussion today. Thank you. Bye-bye.
Thank you. Thank you so much, Dr. Mari Elka Pangestu, who's the Presidential Envoy for the Global Blended Finance Alliance for Indonesia. And as you can hear, she's doing a lot of work amongst emerging markets. So let's pick up more on what she's been saying and have a discussion about that now. And I'll bring our other panelists into the room. Francois, I dragged you in early because your name got mentioned. So obviously you're dealing with the money in Indonesia. So it was good to get that perspective. Could you please welcome our other panelists? We have Felia Salim, who's with andGreen Fund, and was also a member of the board of directors with andGreen Fund. has 30 years experience in Indonesian banking and philanthropic ventures. Justin Werner is the Managing Director of Nickel Industries. I've just realised, I hope I'm not confusing my co-workers in the background with this list or this order. Justin Werner is Managing Director of Nickel Industries. Again, decades of experience in the resource sector and consulting to large resource companies, but also highly involved in the nickel industry. And Nickel Industries has a commitment to net zero. And they're keenly looking for ways to be a part of Indonesia's green energy transition. So we'll hear more about that. We also have Cassandra Williams, who's the Sustainable Finance Program Lead with the Climate Works Centre, which is based out of Australia, but doing a lot of work in Indonesia. And Cassandra is going to take us through some of the work they're doing, particularly around the superannuation fund industry. And of course, we have Francois de Maricourt, the President Director of PT Bank HSBC Indonesia, to give us that global finance perspective. So thanks to all of you for joining us. And like me, you would have been listening very closely to Dr. Pangestu's conversation and presentation then. Felia Salim, I might go to you because you've been watching this for a while. You've been involved in so many initiatives over the years to make this change. Where do you feel Indonesia is at the moment?
Thank you. Thank you, Helen. Thank you for inviting me. Well, you know, I'd like to comment a little bit about the financial sector, that things are mobilizing right now. It's being mobilized for some time now. The state-owned banks, for example, they are already now under pressure from investors, but not only from investors. They had been required by the Financial Services Authority, OJK, to run the stress test. So, you know, a lot of the exposure they have in commodities, land use related, palm oil, oil and gas, coal, especially the state-owned banks are, you know, they have a big exposure. So it's not only they're already seeing through the stress testing, you know, identifying the actual physical risk, the rising temperatures, floods, that's already happening. And if you also see the insurance sector, that's also already responding to much of the data analysis that is now taking place, right? So everybody's on board. It's just about the how-to and starting to really push for the feasibility of projects, right? So for investors to understand, it's really to understand the risk, the climate change risk, be that physical risk, transition risk, but also other strategic risk, right? Regulatory, for example, that is now happening simultaneously as we speak. There are already quite interesting initiatives actually on the ground. You know, there's a bottom up, and I'm glad that Mari is there looking at the big picture, the top down. But the bottom up, there's already a lot of initiative, for example, like the diesel conversion and making it hybrid with solar, looking at batteries and storage. This is happening. There are like more than 2,000, 3,000 locations throughout the archipelago. So there are interesting initiatives that's taking place. Initiative also supported by the likes of the Global Energy Alliance. And now this is now coming together. And I sense there's more dialogue with the financial sector as well as the insurance sector, gearing up towards that. And of course, as you know, the Financial Services Authority is coming out with the regulation, the taxonomy, aligning that with the ASEAN taxonomy, and also very soon the EUDR, right, which is going to affect very much the palm oil sector. So through the andGreen example, there are already, you know, proof of concept that it actually can work. Some blended finance, catalytic funds whereby the three aspects, you look at the sustainable production that is continue to be profitable, that is environmentally sound and socially inclusive, all of the ESG incorporated. So this is where the transition is taking place, that currently we are having intensive discussions with banks, specifically state-owned related banks, how to assist them transition. And banks are also now improving the capacity of the relationship managers, the bankers, to be able to equip them to become advisors of transition, because it really affects their portfolio going forward. So this is now taking place, Helen.
That's really interesting and good to know. Thank you for that perspective. What is UDR, just for those of us who are not?
Is the EU is coming out with a very, what's perceived to be stringent criteria.
Around palm oil.
Yes,
yeah.
No deforestation, which is going to affect the land use, commodities-based, sector.
Just wanted to make sure.
The whole supply chain. But andGreen has a concrete example of having done that. We have several transactions in Brazil and Africa, in Indonesia, and showing that it is possible. But there has to be a willing partner, because there is a good portion of it is possible because there are support from the likes of Norwegian National Capital, FMO. That's important, because that's where the upfront risk needs to take place, as well as partially grants funding, because it's a learning process in order to structure the deal in a way. So it's not one size fits all, but in principle, if you get these three aspects in place, profitability, environmentally sound, and socially inclusive, that's the new operating model. Something that had not been incorporated as a cost in the conventional business model. So going forward, what the cost is, so this is transition cost, we say. And for the moment, it needs to be supported by either guarantee, public funds, catalytic funds, that is blended, yeah.
Okay. All right. That's good. Thank you. Thank you very much for that. I am aware that we are getting some more questions in. I will get to them just so that the people attending realise that. You mentioned how local initiatives are important to showing what's possible. I'm going to go to Justin Werner now, because in a way that's a local initiative. Justin, the nickel industry has got a lot of bad press in Indonesia, particularly around ESG, environmental standards, some questions around local communities. But what you have committed to doing, or nickel industries have committed to doing in the green energy space, or the carbon emissions space, is to have a 50% reduction in carbon intensity by 2035 and net zero emissions by 2050. That's what I'd like to focus on. How did you come to the point where you decided that this had to be done? And obviously you need to do it at a cost, at that transition cost that Felia was just talking about.
Yeah, look, thanks, Helen, and thanks for the opportunity to join the panel today. Yeah, look, our decision to go net zero by 2050, driven by a number of factors. Firstly, I think as a father of three young children, it's the right thing to do from a personal perspective. Anything we can do that will leave the world in a better place than it is when I leave it is something that I'm committed to, and I think a majority of people are. In terms of how we get there and how we reach it, there's a number of initiatives. Firstly, around changing the processing technology that we've been using. So historically, we've used a pyrometallurgical process, which is very high in terms of carbon intensity. And to support that pyrometallurgical process, in fact, we built 760 megawatt of coal-fired power, purely because there just wasn't the power capacity that was available in Indonesia, stable power of that size and scale. And again, it came down to economics. So taking power off the grid, which wasn't available anyway, would have cost us around 12.5 to 15 cents US a kilowatt hour. By having our own coal-fired captive power plants, we can secure that power for about 4.5 cents. See, and power for the pyrometallurgical process is about 35 to 40% of your cost base. We're no longer building any more pyrometallurgical plants. We're now transitioning to hydrometallurgical plants. Those plants, completely different technology. Rather than using furnaces to melt nickel ore into nickel metal, it actually uses acid to dissolve the nickel and other elements into solution, and then it can recover it in that way. There's some innovative things that have been adopted in that technology in terms of the acid that's used is sulfuric acid. We have a captive sulfuric acid plant. In the production of sulfuric acid, a significant amount of heat is generated, which is converted into power. So actually 60% of the power for our high pressure acid leach plants come from the sulfuric acid plant. We're then supplementing that with, at this point in time, Indonesia's largest solar project. That's 250 megawatt peak plus another 80 megawatt hour battery energy storage system. We were the first company to successfully trial the use of electric vehicle haul trucks. But again, we're looking to phase out the use of those haul trucks and use things like slurry pipelines. So rather than digging ore up and using 200 to 300 trucks to go, 20 kilometres there and another 20 kilometres back, even though we're moving to electric trucks, there's still a lot of equipment usage. There's also the fact that you have to build these roads. By building a slurry pipeline, it's a single pipeline that's significantly cheaper, but much lower in carbon intensity. So that's another initiative that we're looking at, or that we're actually implementing. And then the final major one is around the tailings. So historically, just about every mining company has a dedicated tailing storage facility, which requires that a suitable area be identified, be cleared, and be available to store tailings. Those tailings generally, that tailing storage area generally just gets larger and larger over a period of many years, and that's all it is. It's just a tailing storage area. It can never really be rehabilitated or it's basically that land use is lost. We're going to be the first company to actually put the tailings back into the mined out pits, recontour and then revegetate them with fast growing things like sorghum and things like that. And in fact, just on tailings, it's very topical, particularly in the nickel mining industry, given that a lot of tailings is produced. Indonesia and through ITB and other government and private institutions has actually done a lot of very good research on that tailings management, storage, as well as even looking at things like the potential to extract iron phosphate out of the tailings, which is a key part of the lithium iron phosphate battery. Being able to extract iron pellets, because these tailings are predominantly iron rich. So there's actually a lot of good work that's being done in country. Look, not just by us, by a number of the other major nickel players as well. So I think across the nickel industry, we are seeing a very strong commitment to improving the carbon intensity. And to give you some idea of the differences between a pyrometallurgical and a hydrometallurgical process, it's somewhere in the order of 60 tonnes of carbon per tonne of nickel that's produced by the pyrometallurgical process, and 6 tonnes of carbon per tonne of nickel produced by the hydrometallurgical process. I think the Indonesian government, in its wisdom and in its desire to reduce the carbon footprint, has quite rightly put a moratorium on any further pyrometallurgy plants being built. So those there will be no further growth in those. Any new plants will have to be HPAL. And so we see that as a positive. The reason that the first plants were pyrometallurgical. Again, it just comes down to cost and ease to roll out and execute and implement. But we are seeing a transition, and so we think that there's a number of positive initiatives and practices that are being adopted by many mining and refining companies committed to bringing down the carbon intensity. And also, using more clean and renewable fuel. And in fact, the two industrial parks that we operate out of, sorry, Helen, have made a commitment that there'll be no further coal-fired power plants that will be built.
Right, that was actually my question. So thank you, and apologies for the interruption.
No, that's all right. No worries.
Yeah, because it doesn't work if you have to keep using coal to create that mining facility. And that's a fantastic overview of what's happening in the industry. So thank you very much for that. We have been talking about blended finance. I'm guessing that you didn't need blended finance, so to speak. It was something that you capitalized yourself. And do you think, Francois, maybe you can come in here. Is this an example, I guess, of the sort of project that's considered worth investing in and perhaps has less barriers than if you're dealing more with the state regulations or the big projects that can be scaled up?
Yeah, I think that there are a couple of projects that can be supported by blended finance. And actually, with a JETP, there has been a lot of work that has been done in terms of identifying some projects and try to define if they can be financed by commercial banks alone, or if there is a need to have also some public financing in order to de-risk this project and make the economics works. So I mentioned already the case of Shribon 1, but there are quite a lot of projects where blended finance would be very good. And I can mention, for instance, we know that there are a lot of investment required in terms of transmission. The government of Indonesia has assessed the total cost to be $30 billion, but the return on investments for all this investment in transmission is not very high. So it cannot really be financed by private finance alone. And then there is a need to decrease the cost by bringing in some public finance.
And thank you. And Justin, how did you finance what you're doing at Nickel Industries?
Yeah, so just on Francois's point, yeah, look, the transmission lines is the big constraint to there is a wealth of renewable energy projects across Indonesia, particularly hydro projects, but and we've touched on it already a number of times, dealing with a monopoly like PLN. It's very difficult to even get funding for a project when you're reliant on transmission lines that you're not sure when they will be delivered or if they'll even get there at all. But we didn't fund our solar project, so that's something that we identified the area and the opportunity. We then, in partnership with a local Indonesian company, they were a small-scale solar producer. They had a sort of a small project that they'd successfully executed in Sumba. So, I mean, I think that's where the opportunity is we are a large net energy consumer, and so for any organisation that is looking to supply energy into any of our refining or into the industrial parks, there's certainly significant opportunity. But in terms of the group that we're partnered with, it's a mixture of private capital and bank support. I mean, they're companies looking at infrastructure style returns, 10 to 12% equity IRR. So for them, the debt finance piece of their financing is very, very important. That's what determines their returns. And then again, the other element is obviously feed-in tariffs. I think one of the attractive things for them dealing with us as a single business is dealing with PLN. historically, unless you're under, say, for example, 10 megawatt for a hydro project, you had to negotiate your own feed-in tariff with PLN rather than having a fixed feed-in tariff. And then in the example of hydro, where a set feed-in tariff was set for sub 10 megawatt hydro projects, there was no inflation escalation and things like that. So, I think dealing particularly for, people at clean energy companies or providers that are looking to sell their energy, someone like us is obviously attractive. It's a single customer, we basically we take everything that they can produce.
Thank you, Justin. And if you have any questions about any of the concepts that are being talked about, please, again, just put in the Q&A and don't be afraid to ask a question, what do you mean about this? Because this is a complex subject. I've got a few what do you mean about this in my head at the moment, and we'll try and get through those as well. So don't be afraid to ask even the simple, obvious question, because it's likely that somebody else is asking that as well. As we work through this interesting but multi-layered issue. And with that in mind, I'm going to bring in another layer to this by talking to Cassandra Williams from ClimateWorks, because as we know, the Australian superannuation fund industry has $4 trillion in assets now. And there's a question regularly asked here in Australia is why aren't they investing some of that money in the green energy transition in countries like Indonesia? It seems like a great way to collaborate. Cassandra, you've been working on this question for quite some time, and you've heard some of the things that are happening. What is holding back superannuation funds in Australia?
Yeah, thanks, Helen. That is a great question. We've got $4 trillion or close to $4 trillion today in our superannuation system. But you have to remember superannuation has a fiduciary duty to its members, the people that actually own the money, and that is to deliver, appropriate risk-adjusted returns. And when we're looking at the energy transition, when we're looking at Indonesia as a country specifically, you have to weigh up that country risk, and that is a really big barrier. The second most critical piece, which is kind of the elephant in the room in every conversation that I have, is around the Your Future, Your Super performance test, which is which was created in 2021 to ensure that super funds are performing at a level that is acceptable and benchmarked against indices. But what this has caused is unintended consequences of investment hugging and only investing within the benchmark. And when we look at Indonesia in particular around emerging markets, we have an emerging markets index, which would mean that super funds could invest a small percentage of the $4 trillion here. But more critically, it's the infrastructure piece. It's the infrastructure asset classes. And not only is it, not enabling sufficient investment in Indonesia, but also within Australia. Again, it's that fiduciary duty. And there are some pretty dire consequences if you fail the performance test, and we have to remember that. If I look at, everybody has been talking about, and Ibu Mari, definitely reiterated this, GFANZ has said there's $130 trillion in investment money. There is a bucket load of capital ready to be deployed. But where are the projects? Okay. But also, we talk about investment ready and bankable projects. Move along the investment spectrum again and think about this as a superannuation or a pension fund investment ready. That's even further down the spectrum, because we have to look at risk adjusted returns for members based money. So having blended finance and concessional capital is absolutely critical to move investments along that investment spectrum. We can have venture capital, we can have private equity, but again, that's all looking at a significant return, but prepared to take on the extra risk. Super funds, institutional investors not only have, the project risk, there's the country risk, there's the foreign exchange risk, there's the geopolitical risk, there's the sovereign risk, like you name it, the level of risk is just too high. So how do we bring it down? And that's the question that we address here at ClimateWorks every single day, is how do we bring down the risk of investing in projects that decarbonize our economy? Like, that is our job. That is our day job. There's a report that was released by ASFI, which is the Australian Sustainable Finance Institute, just on Monday, around investment in Southeast Asia. And it's got some really critical pieces of information garnished from direct conversations and stakeholder interviews with superannuation funds and banks within Australia. One of the biggest barriers is not having boots on the ground. So actually not having a physical presence in Indonesia is a real barrier. How do we change that? I know myself, I've been texting with him. We've got analysts on the ground in Jakarta. We have a whole team in Jakarta who is looking specifically at Indonesian projects. When we look at investments and institutional investors and superannuation funds, I always double down on their fiduciary duty, because they need to be returning a profit. This is not free money. The free money needs to come from another avenue, but the institutional investors and the pension funds, they're patient capital. They are long-term, sizable investments that are there for the long term. And that is what we need when we come to, climate solutions and sustainable solutions. I mentioned before that we've got a project team on the ground in Indonesia, and I see some of the work that we're doing there. We're replicating it in Indonesia, in Australia, and vice versa, and also in Vietnam and some of the other areas within Southeast Asia. One of the projects that we're working on really closely is NZIPs, NZIP, Net Zero Industrial Precincts. This is a way to attract new industries, stimulate green exports, build and enable infrastructure by really putting everything together in a place-based investment approach. In Indonesia at the moment, we're in scoping phase to select potential locations to establish the NZIPs. And after that phase one, we'll work with governments and investors and precinct owners to create a transition plan to actually build it out and scale it up. We've had lots of success here in Australia at the moment. This is not a short-term solution. This is a longer-term solution. And one of the questions that came through on the chat, Helen, was about what about the societal impact? We have in Australia the Net Zero Authority, where they're looking at this. They're looking at their priority is regional bases in Australia, where there will be a change of industry from coal-fired plants to more sustainable energy. And how do we help support that whole of economy, that whole of social infrastructure? And the second project that I wanted to mention that we're working on in Indonesia is our Seafoam project. Now, this is our own internal acronym because there are not enough acronyms in our world, we found. It's the Southeast Asia Framework for Ocean Action in Mitigation. Now, that's based in Indonesia. This is all about how do we create ocean-based climate solutions that have potential to deliver phenomenal gains in reducing our annual greenhouse gas emissions, but also are absolutely bankable. They're absolutely investable. And this is about innovation and technology and thinking outside of our existing ways of working. So that's really important to us at ClimateWorks, because we sit under Monash University and we are about research into action. But I often have said money is like water. It is going to flow in the direction of least resistance. So how do we, and ClimateWorks in particular, help create those pathways to get the money flowing to where it is, but also satisfying all of those stakeholders along that investment spectrum, because it will take multiple actors to be able to crowd in this capital. So I've spoken a little about Your Future, Your Super, which is a really big barrier to super funds investing in these solutions, both domestically and then internationally in Indonesia. But, it's also about that capacity building and that knowledge and giving investors comfort about what they're actually investing in from climate solutions, but also about, you know, having that knowledge around the Indonesian markets. And one of the recommendations from the ASFI report was definitely just like, how do we incentivize banks and financial institutions that don't have a presence in Indonesia to leverage off their capabilities from other organisations on the ground, or to establish facilities there and help with that capacity building. I sit on a couple of GFANZ committees, and one of them is around the capacity building in Southeast Asia for the GFANZ members. And capacity building is massive. It is about helping to uplift that knowledge. Look, all of us here on this call, on the panel, probably live and breathe this every day, but you know what? Not everyone does. And we have to remember that and bring everyone, I don't like saying it, but on that journey. But that capacity building piece is really key. And also with the blended...
Sorry, Cass, just to pick up on that, in the capacity building piece, I mean, this has come up in relation to not just around finance, but also the capacity for a country like Indonesia to have the products, to have the skilled workforce, to have all that's required to make the green energy transition, and make it a success. We're talking about finance, you're talking about financial capacity and Australian banks. I suspect that a bank like HSBC is already doing that. Francois, you might like to jump in here, and also our other panelists, feel free to jump in, because I think Cassandra's raised a few interesting points there that we can talk to. What is the capacity like in Indonesia, Francois, and perhaps Felia?
So I think that it depends on what kind of project that you are looking at. I think that in terms of capacity, there are some gaps, but we see actually very fast improvements in terms of capacity available. And so if you look at all the work that has been done by the government of Indonesia, when they committed to reach net zero by 2060, at COP 26. And since then, you have quite a lot of departments in the government of Indonesia that have been working on this transition, and more specifically on the project. And if you look at the large companies in Indonesia, they have, by and large, invested quite a lot on building the capacity and ensure that they can prepare some projects that are bankable, and then really look at the structure that will work.
Felia, you were talking about how banks are changing in Indonesia. Does that relate to some of what Cassandra was talking about?
Absolutely. I think everybody's gearing up for it, having done the stress testing across the multi-sectors that they're exposed to. Bankers are looking at the various opportunities, the green financing opportunities today, testing sustainable link lending, stuff like that, and testing it. But definitely this comes alongside of improving the capacities and capabilities of their team, of the relationship managers. That's been going on for quite some time now. In particular, I mean, I'm just citing a few sectors. Obviously, agricultural, the agro and forestry sector. That's definitely. They're looking at now land use, also circular economy, looking at the bio waste for energy and electricity. There's so many projects ongoing right now, being tested. You know, the agro waste management, the biogas plant financing. There's many projects that is still being tested. On the retail mortgage, for example, definitely in the power sector, in the transportation sector, there's a whole array of initiatives that's taking place. But again, these are being tested by the large bank because they can afford it, and they are under pressure. So this is what I'm observing.
What about, sorry, Felia, what about the net zero industrial precincts that Cassandra mentioned as a pilot?
Yeah, they're looking at the industrial estates, right? They're also looking right now. What is an alternative to the coal-based power generation? They're looking at solar, but of course, then the discussion what Francois mentioned, or was it Justin mentioning about the feed-in tariffs? That's some pending issues that hopefully with this government we can resolve much of the bottlenecks with PLN. And policy studies are being done looking into how to transition out or a roadmap for the subsidy, for example. The subsidies to allocate for innovative green-related projects, to allocate those subsidies. I mean, these are just still policy discussions taking place, but that could help accelerate as opposed to plowing it all on coal for the subsidies.
I feel like what's happening with nickel industries is a really good example of the actual challenge facing the country, how the change could be financed, but you know, the sticking points around it and what's required to actually make it work. Francois, you wanted to say something as well?
Yeah, and perhaps just to build on what Felia was saying, right? We see already in the private sector a lot of captives that are moving from coal to gas. So it's still fossil fuel. It's not perfect, but it still reduces significantly the emission of CO2. So clearly, I think that when we see the projects that are happening in Indonesia, there is really a lot of pressure to move to a lower CO2 emissions, both in the private and public sector, especially if you are part of a global supply chain. More and more, you will be audited, and you need to be able to demonstrate that you don't generate too much CO2 if you want to work with certain companies. So really, I think it's moving very fast, and especially as you referenced earlier, President Prabowo has made a very strong commitment when he was at G20, which is to do coal phase out within 15 years, and also build 75 gigawatts of renewable energy within 15 years. So I think it will really focus a lot of stakeholders in Indonesia to increase significantly the investment in renewable.
Cassandra, do you think these initiatives and perhaps changes in mindset that are being made, or at least being considered, would give, say, those investors in Australia more confidence about Indonesia?
I mean, it's going to go some of the way. I mean, what every investor is looking for is the end return. This is, you know, blended finance has a very different role to play in the market to, you know, a traditional investor. What investors are looking for is a transition plan, and making sure that it is credible and moving in the right direction. Because even in Australia, you know, we have just had climate-related financial disclosures come in on the 1st of January. So, you know, very, very soon. Institutional investors and superannuation in particular are caught up in that. And so they actually need to report on their portfolio holdings. And
could you just explain that a bit more, the climate-related financial disclosure?
Yeah, so it's a mandatory requirement now of organisations and businesses to be able to report their climate-related financial disclosures and material risks that are stemming from climate. So it's a mandatory requirement. And there's a tiered approach within our system around, you know, the big companies. So our ASX, you know, 200, so your top companies in Australia, the mandatory reporting will start on the 1st of January. And then it is progressive from there. And what that enables is more information around the risks, the inherent risks that will occur within a business that may change whether you want to invest in that business, whether you want to use that business in your supply chain, because eventually it's scope 1 and scope 2, but eventually it will be scope 3. So it actually just opens up more information about what your climate-related risks are, but it will also give us, you know, a risk is just an opportunity that hasn't been discovered, is what we say in the investment world. And so, you know, it gives you more opportunity about the insights of that company and where they're headed from a transition planning point of view.
Okay, I'm just checking. Thanks, Cassandra. I wonder, Francois, if your experience of companies and their assessment of the climate disclosure financials, apologies if I have that term back to front, that Cassandra just mentioned. I mean, I'm just trying to find commonalities, I guess, and then how that relates to Indonesia. That's something, no doubt, that you've had to deal with perhaps when working with European companies.
Yeah, if I look at Indonesia and European companies, so European companies are clearly ahead of the game, and you have seen already a lot of work that has been done in terms of disclosure and in terms of decreasing CO2. When I arrived in Indonesia 4 years ago, when I will engage to some of the biggest companies in Indonesia, the level of maturity in terms of transition to net zero was not very high. But I have to say that it has improved significantly over the last 4 years. And I really now have a lot of discussions around transition to net zero with a lot of our clients, and quite a lot of them have really worked very hard. They've appointed some people to manage their sustainability, to prepare the report, to understand their CO2 emissions. And so it has really progressed a lot, including in state-owned companies. Just to give you an example, and it's public information, we have helped Cement Indonesia Group, that is quite a large SOE, to build a sustainability framework. And under this sustainability framework, they were able to have some sustainable finance, SLL, sustainability linked loans, in order to have a lower cost from the bank if they met certain KPI that are related, of course, to the implementation of TNZ. So we really see a lot of work that has been done. And I think that Felia was also mentioning the green taxonomy that has been released by the OJK, which is not perfect because still includes some CFPP as transition finance, which is an interesting concept. So I'm not sure to fully understand it, but already there is one. And the OJK is pushing 12 banks in order to improve their sustainable finance and increase sustainable finance. So we are really seeing things are really moving fast in the right direction.
Thank you. Would anyone like to respond to that or raise another point from that? Just I've got so many super brains in the room. I feel like my questions aren't cutting it. Great. We have got time for one more quick question. I just wanted to alert Francois to a question around the technical assistance facility and the percentage. It's quite technical. I might just send that to you separately, Francois, I think, if that's all right. Yeah, somebody's asking the question here, what is the optimal role for the private sector and transitional capital allocators to play in the Global Financial Alliance? I think this is what we're trying to understand, isn't it? Where do all the parts of the puzzle fit? And from what I can tell, there are definitely efforts being made to find ways to create projects that are about this transition to a cleaner climate, to lower emissions. The capital's there, but there are some regulatory challenges still. There's some infrastructure challenges still. And it seems to come down to perhaps the more assurance that's required to make the private investors move in. Just one last question then to everybody, and this includes you too, Justin, because especially you're in the private space, so you have to, you're thinking about ROI all the time. Do you think we are getting closer to finding the projects that will suit the blended finance model? I'll just go around the room quickly and get your thoughts on that, and then we will have to close. Felia, I might start with you first, if that's okay.
Well, yeah, my direct experience has been with the land use related commodities base. And obviously that's a huge, huge sector that is still of national importance. So putting our attention more on that is very helpful. There's already proof of concept. But yes, I have been talking to several of the state banks, and one testing ground that they're probably still exploring is they usually have a subsidiary asset management and maybe pilot it there. And because it's really not one size fits all. I think there's somebody asking in the chat, about the grants portion.
Mm.
Only the large companies are able to